Hello, my name is Joelle Hall. I'm the lead advisor with Hall O'Brien Wealth Counsel, and I'm here today with Craig Basinger, Chief Investment Strategist at Purpose Investments and our outsourced Chief Investment Officer. I'm speaking with Craig today to get a bit of a sense of what we might expect in the markets for 2023. So, Craig, let me start you off with, can we expect the volatility that we experienced through 2022 to linger through all of 2023?
Um, I mean, of course, we'd never know that answer definitively, but I would say a couple different things to that. One, I would say the short answer is probably yes. Um, the I do not think we do not think the markets are completely free and clear of, let's say, what ails them at the moment. But on a silver lining, I would also say it's going to be somewhat different than last year. And even though we don't want to harp on last year because clearly it just wasn't all that much fun, I would point out that last year was very unique because it was a period that inflation became a problem. First time in quite some time. It was a period where central banks raised interest rates very aggressively, obviously to combat said inflation. And, from a math heavy or math tilted perspective, it changed the discount rate on all assets, and essentially all asset prices came down at the same time, which clearly nobody likes because that means your stocks come down and your bonds come down, and it just means, hey, this isn't nearly as enjoyable as, well, clearly the previous year. Um, but I do think as this year starts, and we've already started to see this, is that inflation problem that was clearly the biggest issue in 2022 has started to fade, and this is good news. And I think this also explains why we've had better market performance over the last, call it number of weeks. And every time inflation has started to improve, the markets have sort of rallied around that is good news. And I think that's the good news side of it. However, I think that inflation concern is gradually going to be replaced with quote unquote recession risk. And we don't know what it looks like yet. We do know the economy is slowing down materially, but it is, it's still uncertain if it's an economic slowdown, if it's a soft recession, if it's a real recession. And I think that's what the market's going to probably wrestle with in 2023, which doesn't sound great. But the good news is it's not inflation, which means that actually all of a sudden portfolio construction starts to work much better. In other words, the defensive components should start to behave better than they did last year, and sort of counteract some of that uncertainty or volatility.
Okay. So what is it that you're looking for that you think will take us out of the bear market?
Yeah, and I so this is a bear market. Like, I think we all have to sort of concede that, but I would also say, eh, is it? So,
Okay.
I mean, I mathematic, or the typical definition of a bear market is the equity market goes down 20% or more, and 100% you can see that if you look at sort of the global equities have gone down more than 20%. You can see that in the US market. It's only down, I think, 12% now, but it was down 20% at one point, so check that box. I mean, Canada at worst, I mean, I think we got down 10% and over the last year and a bit, and we're roughly just down sort of 3 or 4 or 5% since the beginning of last year as of today. So, you know, let's say if that was a bear market, I mean, we've seen worse. But I do believe it is a sort of a bear market with some sort of market cycle ending kind of behavior, and that might
Okay.
sound ominous, but it actually isn't. It's I think we're going through a resetting of asset prices, of returns, of expectations, and that's kind of the process that we're going through. And I think we've already seen that in the bond market. Like, all of a sudden bonds have yields again, which is kind of nice. Cash has a cash has a return all of a sudden, which is kind of nice. So we're going, and leadership is clearly changing. I mean, if you look at sort of the growth stocks and the high flyers from the last cycle, they've clearly come down much more than a whole bunch of other parts of the market. So we're seeing sort of a change in leadership and dynamics there. And I think we're sort of going through this process. And in my mind, this process has a couple more legs to go. I think I think earnings are probably going to start to slow down very soon. And I think that is part and parcel with what's going on with inflation, because inflation, as well, it was bad and nobody liked it. It was very positive for corporate earnings. Surprise, surprise. If you can raise your prices 2 or 3 times a year, all of a sudden you can actually generate more money, even if you're paying your people more. So I think there's some dynamics there that probably the market has to wrestle with before this is sort of all over. And then we say recession or recession risk, and I'll acknowledge the market very often looks over the valley of economic weakness, because it's the market's much more forward looking. Um, but I would also say that I don't even think we're at the edge of the valley yet, so it's really hard to try and look across the trough when you're not even haven't even got up to the edge of it. I think that's kind of where we are today. So I think the big uncertainties this year is, what does the recession sort of look like? And I think as that starts to sort of build a picture, and people get a better grasp of what that could potentially look like, I think that's could cause some market weakness, but could also then lead to, I think, the market bottom of this bear market. So I actually think the bear ends this year.
Okay, so if you're making refinements to portfolios, are you making refinements in anticipation of the recession, or in anticipation of what's coming next in the next bull phase?
It depends. I think
Okay.
there are certain areas where you can start to consider sort of the next full bull cycle and start to position for it. But I think you can't do that without also making sure that that lines up for, a potential economic slowdown. So, for instance, in our North American dividend strategies, we've been leaning more and more into defensives in North America. So, our biggest overweights are healthcare and telecom, two very defensive spaces. However, we also have decent weightings in some of the global cyclicals, which might sound counterintuitive. I mean, if they're sensitive to the global economy and we keep talking about recession, what are we doing in things like a copper mining company and more energy names and fertilizers? And the fact is, this is what's making the cycle also unique, is we're probably moving towards economic weakness in North America, Canada probably quicker than the US because of our sensitivity to housing. But at the
Yeah.
same time, China was already in, let's call it a recession or something
Hmm.
last year, caused by two things: the real estate market and their zero COVID policy. Now, both of those are actually starting to improve. And so we could actually be in an environment where the global economy starts to actually do better, but North America is starting to slow down. And that's where it gets really much more complicated, because then you're sort of like, hey, in this sector, like in industrials, which is one of the sectors in the equity stock market, is more sort of North American sensitive. We're very defensive, but in the more global sensitive areas, we're a little bit more cyclical or exposed to the economy. So it it's challenging. Like, I think the next cycle is going to be pretty different than the last one, but I think you have to also, just be cognizant that, in North America, we could be going into a period of softer economic growth.
So if that's the case, how are you thinking about fixed income in portfolios?
So we're actually, I don't want to say a fan, but but we like them. So, in some of our multi-asset work, we started last year underweight bonds, and fixed income and short duration, and owned more credit exposure, so more corporate and the like. And we were underweight in that space, and we had more alternatives. And then fast forward to now, and we own less alternatives because we can now get defensive bonds at a good price. And we've moved up to market weight on the bond side, and our duration has come from a very low number. So that's the sensitivity to interest rates. So just we were more short-term bonds at the beginning, where we're getting closer and closer to what I would call a neutral. So our bonds are now getting longer and longer. And the reason being is that, bonds, nobody liked bonds last year. There's no question about that. and but if recession is increasingly the risk factor out there and it's not inflation anymore, then all of a sudden bonds become your friend. And from a portfolio perspective, not my personal friend, but and it's also, if you look at the actual bond market, I mean, a lot of people use managers or ETFs, so they just see the one line item. But if you actually look at the underlying bonds, like just so many of them are at 85, 90 cents on the dollar, and have pretty attractive yields. And I think that's a better opportunity. And I mean, I also think it actually balances out the returns of most portfolios going forward. The last 10 years, it was all equity markets that did all the heavy lifting, and the bond allocation just did very little, and then obviously a bit of negative at the end. But going forward, I just think that the return distribution is going to be much healthier because you're going to actually get some return from your bonds and potentially less from your equities, but still it'll be a better diversified experience.
Okay. Any closing thoughts for us?
Um, Yeah, I mean we're pretty constructive on this year. I would say that I still think as this inflation is coming down. Regardless of the big year-over-year headline numbers, things are getting better on the inflation side. And I think as that gradually improves this year, the market will stop focusing on it nearly as much. And I think that could easily lead to a decent bounce in the near term. But again, I think, as earnings become a bigger concern and, the risk of more of a North American centric economic slowdown or potentially recession, I think that's going to sort of weigh on markets in the near term, which again is positive for bonds, maybe not positive for equities. But I think, at some point at some point this year, the market will start looking through that and start to recover as the new cycle begins.
Okay, so there's a message of hope for 2023.
Absolutely.
Good to hear. Well, and let's end on that note, because happy endings are always preferred. So thanks very much, Craig. Appreciate your time, and we look forward to the next chance of speaking to you about what to expect for the markets.
Great. Thanks and Happy New Year, everyone.